After the central bank meetings, let's have a look at commodities. Obviously, the higher dollar has had an impact on just about everything, but oil is slightly different, to be honest. I mean, we've got oil prices being dominated by geopolitical risks, adequate supply, and the new Fed rate outlook. So it's been choppy, but having said that, within the volatility we've seen, the recent trend since the towards the end of January has been down. And I think realistically, the geopolitical risks, we do see often a bit of a rally into the weekends just in case. But I think a higher dollar has really reduced, um, the chance of early Fed rate cuts have diminished. So I think, with rates staying higher for longer, I think that's attractive for the dollar. US yields in the 10-year space above 4% is very attractive. So dollars come into the US from outside of the US. We've saw oil sort of drift down on the hope of a ceasefire between Israel and Hamas, but I haven't seen that really sort of develop into anything yet. So maybe there's still upside in oil, but um, I think the big issue for investors is whether we see a wider conflict in the Middle East and Red Sea. Now, that could hit supply chain components. We saw some of that. A lot of the CPI we saw in the US was actually due to sort of increased prices through shipping and container freight prices and the rest of it. So the Red Sea, not blockade, but the skirmishes there are seeing shipping containers diverted, and this is putting the price up. So we could see this coming into a bit of inflation. So for me, I see a higher dollar um, uh, pressurizing commodities in general, but oil as well. And we are beginning to see a bit of a weakening in global demand. European economy is weak. The UK economy is turning over. China is weak. Japan data is not very strong. It's just the US that is holding all this up. Now, they produce a lot of oil as well. So I do think geopolitical risks will become a little less relevant unless we see an expansion within the zone, which is a danger still. And many central banks have mentioned that fear. But I do think there's also potentially some talk going around that maybe if we see oil below $70, then we could see the US replenish their SPR. This is the strategic petroleum reserves that they keep a stockpile of. They've reduced those a lot recently. The US administration seemed very keen to keep oil prices down, whilst OPEC is actually going the other way. So I think it's going to be very interesting where we go from here. But at the moment, oil looks pretty heavy. And it would take more of a spark in the middle of the Red Sea, if you like, for oil to turn around at the moment. There's a lot of oil about. But, Richard's the expert on the charts. What do you got for us, Rick?
Well, with oil as well, it's quite an interesting picture at this stage. I mean, obviously we've seen this quite aggressive sell-off from the late January highs into the February lows, and the market has reacted to that and seen a recovery, and it's been a fairly reasonable bounce. But the important point is to ask: has this upside move really brought about a significant positive shift in sentiment after this sell-off? And really, the evidence at this stage is that it hasn't. The MACD is still below its zero line, which means effectively that it's still a bearish trend. And while that remains the case, any downturn in momentum would suggest that we're starting to see pressure building to the downside once more, and that can resume more negative themes to break those February lows. And when we draw in the Fibonacci retracements of this latest downside sell-off, we can see that 74.44 is the 38% retracement level, and that's quite an important resistance level. It's the minimum bounce that you would expect as a reaction to a downside move, and as such, a potential failure level within a developing downtrend. So if 74.44 continues to hold, the market then encounters fresh selling pressure, turns lower, that sees momentum turn down within a bearish trend. That may well see risks turn towards fresh declines. And if that starts to see the support offered by the Bollinger Mid-Average, which is now flattening out, which stands at 72.90, that could well be the catalyst for acceleration to the downside and fresh weakness. So For me, 74.44 is going to be quite an important focus to the upside within this rally. And while it holds, I think the market still needs to do quite a bit more than it's doing to really suggest that a more sustained period of strength is back on the cards once more. So 74.44 is going to be watched pretty closely in my opinion.
Thank you, Richard. Sticking with commodities, gold. Again, I do think gold is a bit of a byproduct of what the dollar's doing at the moment. We've seen it sort of move back down lower as the dollar rallied. When the gold markets are relatively quiet, the dollar does play quite a strong role in this, and obviously bond yields as well, which drive the dollar, of course. Fed Chairman Powell's appearance on US TV on Sunday was quite interesting because he seemed to want to make it clear to a broader audience why he is not cutting rates yet. And, he understands that he's got to be reluctant to cut rates too early because of inflation, and the strength of the economy doesn't seem to suggest to me, with the consumer doing what it's doing, that they should be cutting rates at all at the moment. So I can understand why he wanted to make that quite clear. But as you can see, gold, when he spoke in that hour chart, we did see gold come off. And that was a fairly hawkish message that Powell sent. And that took the dollar up and thus gold down. If we look at 10-year yields on the chart on the bottom right here, the rise since January the 30th has been quite steep. 4.16% on a 10-year yield is a pretty decent return for investors. And again, this could be sucking in dollars, and I think this could continue. So unless we get a spike in geopolitical tensions, I think the dollar is going to continue to make a little bit of a more impact on gold than anything else. So the higher dollar and higher yields in the short term are being a threat to the longs in the market at the moment, and they're still there. And I think the solvency of regional banks at the moment is becoming an issue again. New York Commercial Bank is down 60%. We're seeing banks in regional banks in Japan and across Europe, in Germany in particular, coming under pressure as well. We saw further losses in some of the regional banking sector today. This is a potential systemic risk at some point, not yet, but if this really does start to spread, that will see gold back up again, because gold always reacts to systemic risk in the system. It's the old safe haven, if you like, going back decades. It's quite traditional, but gold does do well when there's stress in financial markets. So at the moment, the sort of red flag at the moment, if you like, are these regional banks in the US and a few others. But Richard, what have you got on the charts that's a little bit more in depth than I've got here?
Well, I'm afraid I can't really say anything too enlightening with gold at the moment. If we look at the daily chart, we can see that it's caught between clear, distinct, converging trend lines, and this basically is a battle between buyers and sellers who are unsure who has the dominance within the market at the moment. So the converging trend lines tend to highlight this tightening of the trading range, which obviously in itself reflects lesser volatility, lesser opportunities to trade the range perhaps. And that tends to suggest that we need to see a breakout from this range to really establish the next directional risk. So for me at the moment, gold is really a question of the 2065 February 1st high and 2015 February 5th low. And it's really going to be a break of either of these levels that sees the directional risks begin to gain their upper hand. If we break higher, we could revisit the December 4th highs, and obviously that significant spike high. If we break lower, then we may well test the December lows at 1973. So, in general, I think it's a matter of watching defense of these points. Perhaps less opportunity from a trading perspective if we're seeing a slackening in volatility. And it really suggests that we need to see a breakout from this range before we can really anticipate a more significant move in the direction of the break. Now, this type of pattern is normally a continuation, which would suggest potential, doesn't necessarily guarantee anything, but the potential to break to the upside if we do see, having seen the original upside move, a break out from this range. But equally important would be a break below this February 5th low And that may well be an indication of strength of the dollar, movement in US yields, and the potential of lower commodity prices in general, and maybe an easing in geopolitical concerns. But that remains to be seen. And I'm watching the extremes of this range at the moment.